Hello everyone, and welcome to this weekly presentation of the one chart pattern that can make you successful. Hello and welcome once again. My name is Primo. I am the president and founder of Specialist Trading, and for those of you who are unfamiliar with our website, we are your premier source for information in trading and learning and education in trading the markets. And this can be anything from the stock market to the E-mini markets to the Forex markets as well. To give you a little bit of background about myself, I have been trading for over 36 years. I started on the floor of the Pacific Stock Exchange, where I was a specialist for 9 years. I was on the floor for a total of 16, and of those years I was a specialist for 9, and that was a specialist for Donaldson, Lufkin, and Jen Rett. I've said this many times before. I traded through the crash of '87 and through the bull market that ensued afterwards, and I've seen and traded through just about every market environment imaginable. You can think of straight up markets to straight down markets, anything from rangy markets to extremely volatile markets. And I left the floor in the mid-90s to manage money, also to pursue my own trading. And roughly about 5 or so years ago, I started specialist trading, where I just teach and try to convey to my students all the things that I've accumulated in my 36 years of trading. Hopefully I can shorten your learning curve so that you won't have to trade for 36 years to get to where I am. And trust me, when I say I've been trading for 36 years, I had a very difficult time when I first started out, so I know what a lot of you may be going through. So I really want to help you so you don't have to make all of the mistakes that I did in the beginning of my trading. Now I have a great presentation for you today. I'm going to show you a chart pattern that I actually use in my own trading, and it doesn't matter what I'm trading, if I'm trading stocks, the Forex markets, or the E-mini, and as well it's incorporated in many of our strategies. So I'll show you exactly what this chart pattern is. But before we begin, I ask that you please take a moment to view our disclaimer. I'm going to show you a lot of performance results using this #1 chart pattern, but please remember that we can in no way guarantee that any of these results will be repeated in the future. We're required to show you this, so take a moment to view our disclaimer. And while you're viewing it, also like to mention that if you've attended my presentations in the past, you'll know that I like to take questions, any and all questions, but I ask that my members and students please wait till the very end of the class. This way the presentation seems to flow a lot smoother, and we get to have a lot more understanding as to the flow of the presentation. And many times if you just wait for the next slide or two, your question will be answered. So I promise I'll get to all of the questions, but at the very end just write them down or try to remember them. I'll also leave you with an email address and a phone number if you'd like to contact us after the presentation, okay? All right, so let's begin. Why don't we start out? And as I stated, I've said this many times before, when I first was a specialist, my first year or so as a specialist, I had a very difficult time. I had a very difficult time trying to make ends meet and trying to really go forward with my trading. I would kind of have the approach of being 1 step forward, 2 steps back. Every time I had a nice gain or a nice trade or a nice even month, I would give it all back, and after a year or so I really had nothing to show for it. So I was very lucky that I was able to come in contact with a few elite traders on the floor who became my mentors. And this is what they told me about being consistent and what actual trading should be. They said, Steve, trading should be non-subjective. Okay, in other words, it shouldn't be the type of thing where someone looks at a chart and another person looks at the same chart and you both come up with different ideas. It should be more cut and dry so that it's just not open to interpretation that much. They also said that trading should be consistent. And when we say consistent, it doesn't mean that every trade has to be a winner. That's almost impossible. I know that I have losing trades, but what you're looking for is, rather than that 1 step forward, 2 step back approach, you're looking for 2 steps forward, 1 step back. So you want this kind of nice upward slope in your P&L graph, or this kind of stair-step approach when you look at your results. And then lastly, trading should be as simple as possible. I really feel the reason why most traders lose, it's been estimated anywhere from 80 to 90% of all traders lose, is because they make their trading more complicated than it has to be. And I say this from experience because when I first started trading, if you would have looked at my trading screen, you would have seen a number of indicators. You would have seen me tracking just about every news source in the world, and I just had too many things going on, and there was no way to keep track of it. My mentors probably said the most insightful thing that I had ever heard before. They said, Steve, it is the easiest thing in the world to complicate your trading. Anyone can do that, whether you've been trading for 30 years or for 30 minutes. But it's the most difficult thing in the world to simplify your trading. So as following that approach, as I started to simplify my trading, I started to become more and more consistent. So this is what you should really use, all three of these different categories here. Make sure that whatever you're looking at should be non-subjective, not open for interpretation. It should be consistent, meaning that you don't have these great trades where they make tons and tons of money and then you give it all back. You want more consistency, 2 steps forward, 1 step back. And then lastly, your trading approach should be extremely, extremely simple. Maybe 3 to 5 rules at most, and that's it. Maybe 1 indicator, okay? So let's see how we can put that together, or actually let's see what you're going to learn today. What we're going to talk about is the truth about formation pattern. We know that a lot of traders like to look at formation patterns, so I'm going to share with you the real truth about them, as well as the truth about candlestick patterns. Now, we have nothing against candlestick patterns. In fact, one of our best strategies for trading the markets is based off of a candlestick pattern, but I'm going to tell you the truth about the way most people use them incorrectly. And then lastly, we'll go over in detail the one chart pattern that can really make you successful in my opinion. This has turned my trading around, and I think it'll be able to help you as well. Okay? So why don't we begin by starting out with the truth about formation patterns. Okay? I know a lot of people like to use formation patterns. They've been taught that conventional wisdom teaches us that this is the way you should trade, looking for these patterns. Now, once again, I know some people may have entered the room a little bit later, and that's fine. Thank you for joining us. But if you were a little late to the presentation, we are recording this, but at the same time, if you have any questions, please wait till the end of the presentation to ask any questions, okay? I won't even be looking at the question box, so I wouldn't even see if you had a question or not, okay? Just kindly write them down and remember them. All right, so let's talk about formation patterns, and let's go over some of the most popular ones that people use. First of all, ascending triangle, okay? This is a very popular formation. A lot of people like to use this because it's actually viewed as very bullish. When you get this type of move where you have a high followed by a lower low and then another equal high followed by a lower low, you have this kind of triangle forming. And then conventional wisdom states that once you break out of where these highs were, you should have a very nice bullish move, okay? Now conversely, to the downside, you have a descending triangle. What is this exact same thing but just turned upside down? You have a downward move followed by a lower high, followed by another downward move which just about equals the past low, followed by another lower high, and then this time, once we break the low, we should go strongly lower. So this is a very negative pattern, once again, according to conventional wisdom. How about an ascending wedge? This is another pattern that people like to use in terms of being bearish, because you have this type of wedge formation here where the market is rising, but if you know exactly where to connect all these lines, once this breaks through, the rule states that it's most likely going to be coming down and testing these lows. And just as before, we can reverse it to having a descending wedge, which is actually very bullish. If you know where to place all of these range lines here, once this has broken up to the upside, we should come back up here to test these old highs. Probably the granddaddy of all formation patterns is the head and shoulders, the most popular. People love to look for this pattern in any time frame, in any direction. Basically, what you're looking at is some type of neckline here where the support is, and you have a high, which is the left shoulder, followed by a retracement back to this neckline, followed by another high, which makes the head coming back to the neckline, followed by another lower high, which equals the right shoulder, and then conventional wisdom once again says that once we break this neckline or the support, this is where price will really start to fall out of bed and you'll get a nice sell-off, okay? Now, here is the only problem I have with these conventional formation patterns. Once again, we said the very first thing your trading plan should be is non-subjective, meaning that it should be easy to see, it should be cut and dry. It shouldn't be something that is left for interpretation or it's too subjective to even figure out. Now here's a perfect example. This is an older example of someone would interpret as a head and shoulders, because looking at this example here, we see that we have a shoulder, we have a head formation, and we have a small right shoulder. So looking at this, after doing your study and reading the books on formation patterns, you would have said, well, boy, this is a really negative sign here. So I'm going to short because we broke the support, and I'll sell right here. And then look what happens. You start to go into the market by going short, and then it doesn't go down. So you get stopped out, probably for a small minor loss, but at least you have a loss, and so it didn't work out. And so you start to watch again, and you're just kind of viewing the market. And then days later you say, but wait a minute, you know what? I think I jumped the gun a little too early Now this is the actual valid head and shoulders. We have the left shoulder, the head, and all we were doing is I got in a little too early because now the right shoulder has concluded. It was a little subjective. I jumped the gun a little bit too early, but you know what? I'm going to make it all back. I'm going to go short again, and this is where it's really going to work out. So you go short, you jump in, guess what? It goes right back up again. See what I mean? It's too subjective. We don't want things that work sometimes and other times do not work at all. How about support and resistance? I know, especially in the Forex markets, they love to trade support and resistance. This is a huge model for trading, always looking for some type of pullback to hit some type of support, some type of a nice rally to hit some type of top, which will be your resistance. And if you have a perfect case scenario for it, it would look like this. You have a nice type of rally which hits some type of topping formation, then a bottoming formation, and each time we hit those, that is what is construed as resistance and support. So we're looking for resistance to be broken to the upside, we're looking for support to be broken to the downside. And once they are, conventional wisdom once again says that we'll have a strong move in that direction. Well, here's a chart that pretty much follows to suit what we just saw. We have this nice upward move, downward move, upward move, downward move. So if we label the support and resistance, we would see here that we have, we have support right here and another support right here. So this is telling us that we will most likely come down. If we come down to this level, we should hold. And this is nice support, and we're probably going to make new highs. So this is where you want to buy, somewhere around these levels right here. Well, it came down to that level, and guess what? Didn't hold very well. So if it does not hold here, that's okay. Don't worry. This is much stronger support, and so we will most likely hold here. So if you're already long, don't worry. You're probably going to hold here. And if you haven't got long yet, well, maybe you want to get long here, or else you can actually double up at this point. Excuse me, seem to be having some problems with some... I believe we have too many people in the room. Gosh, this is a problem, a nice problem to have. But if we have too many people, I'm sorry. I think we've reached our limit. Usually we have only space for 100. So I apologize to the people. That's why we keep getting that message right now. So I apologize to the people who have come a little bit late. We'll try, if you can contact our support system, I believe it's Brett Marsh at specialisttrading.com. He can possibly open up the room for more people, okay? I see that's what that message is. And I apologize to the people that are coming in late. And I hope we don't continue to get this signal here. We only perceived to be 100 people in the room, and it looks like we're getting a lot more. Okay, so once again, if you see that sign, I'll just continue to click it off until we can kind of make room for more people. So conventional wisdom would say this is where we're going to hold. So we come down to this level, and look what happens. Remember, once again, we want things that are more cut and dry. We don't want to be guessing and trying to pick a bottom that support is going to hold there, or that we're going to be all right. And that just kind of keep your eyes closed and say, boy, I hope that things just go well because I'm really planning on buying here. You see, that's not the way you should be trading. It's more of a guessing game. That's more of a wishing and hoping and praying game. We want things that are a little bit more consistent. How about candlestick patterns, okay? Now, we know a lot of people like to use candlestick patterns. A lot of traders, a lot of Forex and E-mini traders love to use candlestick patterns. And once again, we have nothing against them, but from time to time, we see that people use them incorrectly. Now, here are the most common and basic candlestick patterns that you'll see. These are anywhere from a doji all the way to an evening star. But probably the most popular candlestick pattern is right here, the engulfing pattern. Simple to see. Pretty much it's just a reversal type of pattern. And most people use this. In fact, we have a strategy, as I said, that is based off of the engulfing pattern. Here's the only problem. Most people use the candlesticks incorrectly. Let me show you what I mean here. Here's a perfect example if we're looking at a chart, and we have a very nice engulfing pattern, all right here. So this would tell us, conventional wisdom, to say that the market's going higher. All right, so if we continue to look at that, we see that we actually did the opposite. We went lower, all right? And the reason is that most people use them out of sync with the trend, okay? Now, there are 1,000,001 ways to find the trend, but we believe we have a nice proprietary way of noticing what the trend is. But still, be that as it may, a lot of people lose a lot of the time because they have trouble discerning which side of the market they should be on. So therefore, the candlesticks won't work. Once again, we don't have that consistency with our trading. As we stated in the beginning, what my mentors taught me and what finally turned my way of trading around was that trading should be non-subjective, it should be consistent, and it should be as simple as possible. Now, the things I just showed you, the formation patterns, were extremely subjective. Someone could look at those and say, well, the support should be here. Someone could say, well, actually, no, support should be somewhere else. Okay, this is not where it should be. It should be somewhere else altogether, entirely. So there are a number of ways in which to interpret what it should be doing, and that's not what we want to do. Other people would say, well, it's not consistent. We're not consistent at all. Sometimes this head and shoulders works, or sometimes this support and resistance works, and other times it doesn't. So we're not consistent in any way with those patterns. And then lastly, they should be as simple as possible. As you've seen here, they're not simple. I mean, many times if you're looking for a wedge pattern, you have to know exactly where to draw those lines. You have to know exactly if you're in an uptrend or a downtrend. So it's not simple. So we don't want our trading to rely on these things that are non-subjective, that are not consistent, and that are extremely difficult to determine. So with that in mind, what is this one chart pattern that can help us to become successful? And in my opinion, it can, because it really helped me, and we incorporate it in a lot of our strategies, and it works very nicely. Well, here it is. Without being facetious and without really being sarcastic, this is what you should look for. What you want to look for is a bar that closes in the top 25%. It doesn't matter if this is a day bar. It doesn't matter if it's a weekly bar. It doesn't matter if it's a 5-minute bar. Because if you see a bar that closes in the top 25%, it is giving you an indication to buy. It's telling you which direction it wants to go. How about if you see this? A bar that closes in the bottom 25%. Well, that as well is a tremendously, tremendously powerful chart. Why? Because it's giving you a very strong indication to sell. So at this point, you should be looking for something that's going to really be telling you some strategy or some type of at least signal that's telling you to go short if you find this. So why is this chart pattern so successful? We have to ask ourselves, what makes this so successful? Well, when a price bar closes either at or near the top or bottom of its range, what's happening is the market, not an outside source, not someone on TV or not some chat room or some trading room or not some trading guru, but the market itself, whether you're watching the stocks or whether you're watching the E-mini market or the Forex market, the market itself is giving you a clue as to which direction it wants to go, okay? And that's the best signal you could ever get. So how do we implement this chart pattern? How do we use it? All right, well, you may want to write this down. Here's the chart pattern rule. Now, once again, you need to have a strategy that will give you a signal to go long or go short. But let's just say you have a strategy that you're fairly comfortable with that works okay. Let's say your strategy gives you a buy signal. Use this chart pattern where you close in the top 25% either as an entry bar or as a directional tool. In other words, directional tool saying that you're going in the right direction, okay? And this is the direction the market is most likely headed. Remember, this works on a 5-minute chart or a weekly bar chart. Does not matter. Let's say your signal gives you a sell signal, or your strategy gives you a sell signal, okay? Use this chart pattern either as an entry bar, in other words, the bar that you enter on, or as a directional tool, telling you that you're going in the right direction. Let me show you some charts and we can clarify this and show you just a little bit better exactly how this works. Okay, so let's start with the stock market. Let's show you how easily this transfers over onto all markets in all time frames and in all directions. All right, here's a chart of TIF, Tiffany. As you can see, we're well in an uptrend. And let's say our strategy is a pullback strategy, meaning that we're looking for a strong uptrend. In this case, we have a nice uptrend. And then we're looking for sell-offs or pullbacks, little dips in prices within that uptrend. All right. So if you see here, we have a very nice uptrend, move to the upside, but every once in a while we have these sell-offs. We have a sell-off to the downside here, another one, then we move higher, then another sell-off where we move lower, then another higher move, then another sell-off, and so on. You see this time and time again, this type of upwards stair-step move. So we want to be purchasing on these little sell-offs or these little bottoming formation here. These are the pullbacks, all right? So if we notice here in Tiffany, on those little pullbacks or sell-offs, we have this nice little cluster of bars that close in the top 25%. So this was our signal either to get in right here or that we were on the right side of the market, that the market was giving us a clue that it's going higher, and as you can see, within days or weeks, we went up 7 points. Now the market sells off again in this little area, and then guess what? We have another cluster of bars that close in the top 25%. You could use either one of these bars as some type of a signal to enter the market, or at least that you're going to go much higher as a directional tool. And then we went up another 3 points, okay? Now we have another rally, and that's followed by another sell-off. And guess what? As we hit that bottom there, we have a bar that closes in the top 25%, and we head up another 3 points. And then it's followed by another sell-off to the downside. And as it goes lower, we have 2 bars here confirming that we're going higher again, and then guess what happens? Remember, we first have to be in an uptrend, and then we have to look for these bars within an uptrend. In other words, if we were in a downtrend, these bars wouldn't help us. We would be looking for the exact opposite, such as this case in ABX. Now, we have proprietary different tools that help us to discern what the trend is at specialist trading. This is privy to all of our members and our students. And so we know that this is in a downtrend just off of face value of looking back in hindsight. But we want to use the same principle. We're looking now for these little bounces and then sell-offs, bounces and then sell-offs. So in the bounce, since we're in a downtrend, now we're looking for a bar that closes in the bottom 25% right here. So this could have been your entry bar, or you could have used it to confirm that we were going lower, and then it's 2 points lower, okay? Then we get another bounce, and we look for a bar that closes in the bottom 25%, giving us confirmation in our entry, and then we go down another 1.5 points. Then we have a smaller bounce here, and then here's the bar. Here's our bar giving us our confirmation that we're going lower, down another 1.5 points. And we're going to go sideways for a while, not a very big bounce, but all along this area when we went sideways, we were just inundated with bars closing in the bottom 25%. The market, ABX, was screaming, we're going lower, okay? And guess what happened? Down 6 points. Do you see how when you learn how to listen to the market, it's a lot easier than having to rely on outside sources such as trading rooms or chat rooms or some trading guru on TV? Once you've learned how to do this, it's a lot easier and it's a lot simpler. And plus you're going to save a lot of money too, and not having to pay for all these services because you know how to listen to the market rather than paying to listen to someone else. How about the E-mini market? Okay, well this works tremendously intraday trading, especially if you're looking at tick bar charts, because so many times with tick bars you will be seeing bars that close at the very high or low of the pattern. Now once again we're going straight up, so we have an uptrend. So this time we're looking for bars that close in the top or very top or top 25% of their range. So as you can see here, we have a very nice sell-off, and then here's the first bar that closes at the very top. Okay? You could have used that as a nice entry, and we're up 4 points. Then we have another sell-off, and here's another bar that closes in the top of its range, and a 2-point gain. Then another sell-off, we have another bar here, signaling you for you to enter, another gain of a point. Another sell-off, and here's the next bar that closes on the top 25%. You actually close at the high, and then you're in the market again for another point gain. And then another sell-off or another pullback. 2 really strong signals here. The market's telling you that it's time to get in. Another 2 points. Do you see how simple that is? Rather than having to try and figure out, well, is this a head and shoulders, or is this an ascending wedge, or where are the candlestick patterns? Just look for this bar. Look for an uptrend, and then look for these bars that close in the top 25%. Now conversely, if we want to look for a downtrend, well, let's look at a downtrend here. I believe this was on the 16th, so this was just a couple of weeks ago. We see here that we're in a strong downtrend in the E-mini. Now, we see a bar kind of going sideways, but there's a very strong bar that rallied upward and then closed at the low, and the market goes down 2 points. Then we have a little bounce here in a 5-minute chart. 2 bars that close in the bottom 25%, down another 6 points. Then another pullback to the upside, a bar that closes in the bottom of its range, down another 3 points. Extremely simple but powerful at the same time, okay? So this is what we're looking for. Things to be simple, things to be consistent, and most especially things that are non-subjective, that we don't have to sit and try to figure them out right away. All right, lastly, let's look at the Forex markets for you Forex traders. This works extremely well on the Forex because the Forex markets are akin to some of the best trending moves there are. In fact, it's been my opinion that they trend even better than the stock market or the E-mini market. So if you're looking for nice trending markets and then these signals within the trend, this is a great market to look for this #1 chart. Here's a chart of the dollar-yen. As you can see, we're in a nice strong move to the upside, and we have these sell-offs followed by rallies, sell-offs followed by rallies. Well, we have a sell-off right here, and right at this point here, we had a nice bar that closed in the top 25%, and right after that happened, well, guess what? We went up 300 pips. Now we had another sell-off, followed by a nice bar that closed in the 25%, top 25%, followed by another 400 pips. Then another sell-off here. There's our bar closing in the top 25%, a 200 pip gain. Then a sell-off again, a bar closing in the top 25% for another 400 pip gain. Okay, so we're looking at roughly about 1,300 pips in just the time span of a month or two. That would be well over $13,000 if you're trading one lot. How about the Australian dollar? This is coming into May, and in June actually we're in a very strong downtrend. We have a nice upward blip to the upside, followed by a bar that closes in the bottom 25%, 200 pips to the downside. That's $2,000. A nice move upwards, followed by a strong close to the bottom here. That's another 400 pips to the downside. Okay. Now this kind of was a sideways move. Wasn't much of a pullback, but you saw we had a bar close, and then we went another 100 pips. So it's extremely easy to see these once you know how to spot them, and you see how well they transfer over onto any market in any time frame. Here's a weekly chart of the Swiss franc. Same thing, a very strong upward move, okay, upward trend. We have a sell-off here. Bars close all in the top 25%. Okay, so after each one of these, we had a very nice move to the upside for a total of 1,800 pips. So on a weekly time frame for roughly about a year, that's trading one. That's roughly about $18,000 if you're able to maximize all of these. How about monthly? Here's the euro-yen going straight down. We see here that all these bars, nearly each one at the very top, gave you a signal that they're going lower. You see why we call this the one chart pattern that can make you successful. And then lastly, you can see how this works intraday. A 4-hour chart of the Canadian dollar. We're in a strong uptrend. These are all bars closing in the top 25% for over 350 pips in just a couple of days. And to the downside in the Australian dollar, looking at an hourly chart. All bars that closed in the bottom 25% range. All right, so let's recap. We explained the truth about formation patterns. We know that a lot of people love to look at formation patterns, anything from head and shoulders to ascending wedges to descending wedges. And they're all well and fine, and I know that firsthand because I used to use them myself in that trading. But like I stated, when I first started trading, these would work some of the times, and then other times they wouldn't work. So after a good period of trading, I had nothing to show for it because the times they did work were completely offset by the times they didn't. So there's really no use in using these formation patterns because they're too subjective. All right. We also told you about the truth about candlestick charts and candlestick patterns. Now, they do work as well, but you have to know how to use them. And it's been my experience that 99% of all traders don't know how to properly use candlestick patterns. Okay? And if you don't use them correctly, if you've been taught the incorrect way, they're not going to work. As you just saw in the examples we showed, they're not going to work at all. So the truth is that they're not that simple. You have to know how to use them correctly. And then we went into detail and showed you a number of examples of the one chart pattern that can make you successful. And this is basically looking for a chart pattern or a chart bar, doesn't matter what time frame, that closes either in the top 25% or the bottom 25%. If it does, it's giving you either a strong indication to buy or a strong indication to sell. Or in other words, it's giving you a strong indication that it's either going higher or either going lower. Okay? And I can't think of anything that is more simple but more powerful than this one chart. Okay? Now, here's one thing we want to stress. When I first started trading, I had a very difficult time. So I know if some of you are going through a difficult time, if you're having a tough time making ends meet with your trading, I know what you're going through. I went through the same thing myself. In fact, for many months on the floor of the exchange, I didn't think there was much time left for me to become a specialist because I just couldn't seem to make ends meet. Once again, it was like one step forward, two steps back. Every time I had a nice winning month, I would give it all back with just a trade or two. So after I learned these things, I started getting onto that road to consistency. And so that's my goal. My goal is to teach all of my members and my students the same things that were able to turn my trading around. These are the same things that were able to sustain me for the past 36 years. So as I stated in the very beginning of this presentation, we are an educational company. Even though we provide you with strategies, with signals, and with different ways to trade, we're more about teaching you how to use these things and all this information I've accumulated so that you can pretty much format it to meet all of your own needs. Okay? Now, the one thing I want you to remember as we conclude this presentation is this is not a strategy. Okay? Simply because you see a bar close in the top 25% doesn't tell you to go long. It doesn't tell you to go short if it goes in the bottom 25%. Remember, this is a pattern that's best used either as an entry bar that you already have to accompany your strategy, or as a directional tool, a tool that is telling you or giving you some insight as to the direction of the market. But that's not a strategy in and of itself. In order to have a full-fledged strategy, you need to have other pieces of the puzzle, such as money management, such as stop placement, such as how many lots to trade. Now, this is a great tool that can give you the direction, the short-term direction. You can apply it to any time frame, any direction, or any market. Remember, the higher or the lower the close, the better this pattern is. Now, if I can just take a few moments to show you how we incorporate this pattern at probably one of our best strategies at Specialist Trading. This is strategy number 4. It incorporates this chart pattern, but we also have about 3 or 4 other rules that help you to decide where the direction is going, what the momentum is, what the direction of the trend is, and then exact entry points. Okay. Now this course is extremely powerful. Usually runs for $6.95, but we're discounting it for all the people today down $200 to $4.95. Let me show you some current signals here, and this is a really great one that a lot of our members took advantage of. This is in Facebook. Now, if you see here, we took a snapshot of what appeared in Yahoo Finance on the 25th of July, just a week or so ago. It starts out by saying Facebook shares jumped 28%. Wall Street sees more growth, more ad growth. Okay, so this is great. This is fantastic. They're getting more ad growth. They jumped 28% after the company reported a huge jump in mobile advertising revenue. All right, so this is great. Most people, after seeing something like this or hearing something like this, jump in and they get into the stock thinking like, this is great, it's probably going to go higher. Well, let's look at the chart. If we view Facebook, we see here that as early as 3 or 4 days prior to that, what do we have here? We have a bar that closes in the top 25%, plus it met all of the rules according to strategy number 4. So our members actually got into the trade on the 22nd or 23rd. This is how good this strategy is. And if you wanted to, you could have actually exited on the opening of the 24th or straight in longer if you'd like to. We show you ways in which to keep in the trade much longer. This was an actual signal that all of our members who subscribe to strategy number 4 service were able to see on their own and were able to incorporate and actually enter into the trade. Here's some more signals for stocks. In Textron, we see here that in June and in July, these were actual signals that our members were privy to go short as well as going long. So this works in any direction and any time frame as well. Now, if you're an E-mini trader, you like to trade intraday, well, here's a chart going back to, I believe, the 19th, July 19th, which was just a couple of weeks ago. We were in a strong upward move on a 5-minute chart. These were all strategy number 4 buy signals. You see how well this works intraday. Now, here's a tick chart of signals that were actually taken yesterday. At the very end of yesterday's close, when the market started to sell off, guess what? Look at all the sell signals generated using strategy number 4. If you like to be a really close, tight-knit type of intraday trader, these were all strategy number 4 sell signals, and this was yesterday. If you're a Forex trader, we go back to the Euro-Yen in April. We had a really nice signal here to go long the Euro-Yen. I believe this would have gained you over 400 pips if you stayed into its max. And then looking at the Australian dollar, these were all signals that were generated, that were issued out to our members of the Forex strategy number 4 service, and they all saw these the night before you were to enter. So you see how powerful this is. If you would have taken all of these signals by becoming a member of Specialist Trading, you would have been able to pay for this course probably about 10, 20 times over, okay? Because it's extremely easy to use, and you can just see we supply you with the videos for entries, exits, and stops. We give you the signal alerts, weekly video trading lessons, a free add-on for Metastock, and then you have access to my personal email address. You can contact me at any time. As I stated, if you had taken all these signals that I just shared with you for the last couple of months, even the last couple of weeks, you would have paid for this course many times over. It's usually discounted to $6.95, or we're really super discounting it for all the people attending today down to $4.95. But that's for a limited time only. Now, if you come to our website where we actually promote individual strategies, which is protraderstrategies.com, you'll see it advertised there for $6.95. Kindly send us an email or call us up, and we will send you the link where you can purchase it at the discounted price for $4.95, okay? So give us a call at 310-492-5392 or contact Don Jans. He's our senior trading representative. You can email him at donjans@protraderstrategies.com. Remember, if you go to our sister site, which sells and promotes all of our individual strategies, that's protraderstrategies.com, you'll see it there for $6.95, but just contact us because we'll send you a special link for that discount down to $4.95, okay? Now, as promised, we are at the very end of the presentation, and I thank you for waiting. If you happen to have any questions, now is the time. I will go over them and just open up the box. I know a number of people were asking, is this going to be recorded? Yes, we record all of our weekly presentations, so if you're not able to make it or if you have to leave early, you can request the recording and we'll send it out to you, okay? One question that is asked is, does the 25% method work on smaller time frames, such as 1 minute or 5-minute range bars? You mentioned 5-minute charts, but nothing smaller. Yes, Greg, it will work, but many times, because it works on the smaller time frame as well, but because the smaller is so congested, you'll have smaller moves. In other words, where if a 5-minute chart might produce gains of 1 or 2 points, a 1-minute chart, or even smaller, might produce gains of maybe 25 cents or a half point. So it's all relative, okay? This is a short-term trend directional tool, so you just have to take that into consideration. It's all proportional. Bruce asks, does it matter how large the bar is? That is more the 4 ticks more than 8 ticks, etc. It's a very good question. The only thing that matters, and we teach you in this class, is if you're seeing a bar that has a very large range, let's say 8 to 10 to 12 ticks, but it's at the very low, that's a good sign because it's really showing you some type of reversal pattern. Whereas if you see it not at the low, but it's a very large range bar and say it's towards the high, well, you know that some of the move has already been taken out of that upside. So you may want to pass on that and wait for something that's lower in the pullback mode, okay? And once again, we teach you all this, and this is incorporated in the course. This is a very important point that's incorporated in strategy number 4. It's one of the rules that we have there. But I can't go into detail, or else I'd be giving away everything. But that's a good question because we incorporate that into the rules. Anton asks if it a lot more than 25% with high volume. In other words, I guess what you're saying, is it more valid if it has high volume? We don't take volume into account, Anton. We really don't take volume at all because over my 36 years, once again, this falls into the subjective category. You know, someone's high volume is another person's low trading volume. And a lot of times I've seen where high volume is fantastic for validating the signal. Other times it doesn't do anything. So I want things that are more cut and dry and simpler to really explain and to see. And volume is just too subjective once again. So when I traded on the floor, I used to look at volume all the time. And then after I realized it's not helping me, so I dropped it from my trading plan, and I started to become more consistent. So volume is something we don't use, and just look at it as it makes it much more easier. You don't have to worry about that anymore, okay? Let's see what the next question is. How do you measure the 25%? Well, it's very simple. All you have to do is once you see a bar, you basically have to, this is something over experience and over time. We always instruct all of our members to paper trade for a while. You'll see pretty much the length of the bar. You'll see where the median point is, where the middle of the bar is. And then you can divide that upper portion by 2. And if it closes upper in the top 25%, that's how you measure it. It's just something you see by sight. Now, if you're looking at daily bars, you can simply measure from high to low and divide by 4, and that's the top 25% will be the top portion which you're looking for. It's really simple, but we explain this in class as well, and we have tools in which to do it for you as well. If we are not in a trend, should we ignore the signal? Yes, and we show you, once again, we have great tools for showing you how to find the trend. We have our broad sense of trend, which is the buy-sell line, which is 50-period simple moving average, and I can just tell you right now, if looking at the broad scope of things, if price is below the 50-period moving average, well, then we're in a downtrend. And if price is above, we're in an uptrend. But we have a brand new tool called the PET-D indicator, which is more of a short-term tool which can show you right away through color bars where the trend is. So it makes it much easier to see. So yes, if you're in a ranging motion, I would just kind of stand back and not use this. Once you get into this really strong trends, it's not like you're going to miss anything. You're going to see a lot more of these successful bars. So don't worry. In fact, you'll see even more of them because they're just giving you more and more clues as to which direction they want to go in. All right. Is this strategy for pullbacks only? Well, remember, the #1 chart pattern I just showed you is not a strategy. So we can't even answer that question because this is just a directional tool or a way in which to define your entry. But if you're talking about strategy #4, yes, strategy #4 is a pullback and a high-level consolidation type of strategy. Okay, so we're never looking for breakouts. We're never looking to pick tops and bottoms. We're always looking to be in sync with the trend. And the only ways we trade with the trend are either through pullbacks or through consolidation patterns. Okay. Rusk is once again asking how we determine trend. Well, without giving away too many things, the easiest way is once again through the 50-period simple moving average. It has worked for me tremendously, and I've often stated this. If I were, stripped away of all the tools that I teach and use and all the strategies and can only use one thing for my trading, it would be the 50-period simple moving average, because it has helped me and more than helped me to save me so many thousands of dollars throughout the years. If price is above the 50-period simple moving average, well, then the overall trend is up. This just means that I'm only looking to go long. I'm only looking for buy signals. If price is below the 50-period simple moving average, this means that the overall trend is down, and I'm only looking for shorting signals. Okay? Look at your past 10 to 20 trades. I can almost guarantee that your losing trades were when you were going short when price was above the 50-period, or you were going long when price was below. If you apply this simple but powerful tool, I can almost assure you that you will save so much money. Okay, so that's one of the ways we determine trend. Are there out-of-pocket expenses in the training room? No. The $495 is the full expense. That's everything. And plus, one of the things I like to explain to all my members, this is not something where you take the course and you never hear from me. You have my personal email address. I was answering emails all day today by members who have been members for years. And so this is not something where you feel, well, once you've learned it, you can't be associated with this anymore. You can continue to email me with any questions. You're a part of the family of Specialist Trading. There are no other hidden costs. There's nothing else. Everything that we say is included in this, we give to you. Now, if you want to buy another strategy or want to get another totally different type of methodology, that's fine. That will cost extra, but it is not in any way mandatory if you're purchasing strategy #4. And might I say that strategy #4 is probably our most popular strategy to date because it goes in any market in any time frame. So it's probably the best strategy to begin with if you're going to become a member of Specialist Trading. Okay. If we have a cluster of signal bars, is the entry more probable? Yes, it's just giving you a sign that there's probably a higher probability for success. Yes, because remember, this is the market giving you clues as to what it wants to do. It's not an outside source. It's not some guy in a trading room or a chat room telling you what his opinion is, or not someone on TV, or not some indicator that works sometimes and doesn't work other times. This is the market telling you what it's most likely going to do. So if you see a cluster, yes, in my opinion, it's a higher probability that it's going to go in that direction. Greg asks, when trading multiple markets, do you recommend trading non-correlated markets since so many move in unison? Yeah, I mean, I don't recommend it. I think that this, once again, is a discretionary type of thing. I know a lot of markets move in conjunction with each other, so a lot of traders like to only trade those. Others don't want to trade them at all. They only maybe want to trade one and then move on to a totally different type of market or category. I think that this is more subjective. This has to deal with the trader themselves. There's no right or wrong answer here. I know personally I'm always moving in and out of these correlated or non-correlated markets, so it doesn't bother me to do that. But I know other traders that only want to stay with one or within the correlated market. So it's really up to you. Let me get to another question here. Let's see. Does the moving average matter whether it's exponential, simple, or weighted? That's a very good question, Bruce. No, it really doesn't. The main thing I would suggest is that you just use this principle that if price is below you're only going to be looking to go short, okay? If you just really understand that principle, it'll really help you, regardless if it's an exponential or weighted. If price is above, well, then the only signals you should be looking for are buy signals, okay? Now remember, just because price is above, I'm not saying to buy at the market. The first close above, you don't buy. That's not a strategy. This is just a tool telling you the right side of the market to be on, all right? So if price is above, you still need a strategy to tell you where to buy, where to get in. So it can be either one of yours or one of mine or something that you have from another educator. That's fine. But just whenever you get a signal to go long, even if it's based off of news, only go long if whatever you're trading is above the moving average, okay? And it should be a 50-period moving average. Some people use too small of a moving average, like a 10-period, or too large, like a 200. That's way too big because that encompasses too much. And a 10-period is way too small because you're really limiting your resources. We found that the 50 works best for just about every market time frame available, okay? So I hope that answers your question. BC asks, do we get specific buy and sell prices? Yes, if you subscribe and become a member of Specialist Trading, we give you signals on daily bars where you should be getting in and where you should be getting out and where you should place your stop. But trust me, after a week or two, you'll understand the strategy so well, you'll be able to spot them on your own. Okay, so if we're looking at daily time frames, yes, you'll be able to get a signal generated in the Forex markets as well as the E-mini markets. Now, if you're looking at intraday time frames, the only way you'll have the access is if you have our free add-on, which automatically generates the buy and sell signals. And that's for Metastock, also I believe for NinjaTrader and TradeStation as well. Okay, let's see here. See, in the example showing clusters, if you look at an early signal, it looked like you might have been stopped out. Well, remember, once again, you only get stopped out when you're looking at a strategy, okay? So we're not, what the examples we just showed you, there were no strategies involved. We were just showing you a directional tool. So by saying getting stopped out means we're talking about a strategy, and we already explained this is not a strategy. This is something that you can incorporate into your strategy that will tell you where to place your stop. So really being stopped out doesn't apply here. So let me go to the next question. In these episodes, if you took an early signal, it looked like you may have been stopped out. Yeah, I guess it's just the question kept repeating over and over again. Remember, stopped out only refers to a strategy because a strategy has rules for placing your stop. It has rules for entry. It has rules for exit. Okay? Once again, that only applies to a strategy. This isn't a strategy. This is just a directional tool or an entry technique. Abdul asks, should we wait for a retracement to take the signal, or is the signal still valid at the top or bottom? Okay, well, remember, once again, you have to have a strategy in order to incorporate this. I would personally wait for pullbacks. Now, sometimes you'll see the market going straight up, such as it did today on an intraday chart. When the market had a really nice rally, it was going straight up sometime during today on an intraday market. You would have seen a lot of these while the market was making new highs. But I personally don't like to take those trades in my strategies. So I will wait for more of a pullback, then I'll look for this type of entry signal. Okay? BCS, are we getting stocks, E-minis, or Forex, or all of them? Well, we have the different programs for each and every one, but we show you ways in which to incorporate them. I think the best thing would be that you actually will get all three. You'll get all three for all these, and Don and Brett, if you speak to either one of those, if I show you right here, if we go, oh, we're already on the page. If you contact Don and give him a call, he'll explain to you exactly what you get, but I believe you get all three. Okay? Get some more questions here before we have to exit. Bruce, you're very welcome. I give these presentations every once in a while. As you can see, they're very educational. I know that a lot of presentations and webinars you go to, they're more trying to sell you something, and we're trying to do that as well. But at the same time, you can use this for free, totally for free. Let's say you have a strategy that has been working just okay or so-so. Apply this simple entry technique. In other words, looking for this bar. Once your signal gives you an entry, rather than taking the normal entry, look for this bar, and that will be your entry. Okay? Now, I'm giving you that information totally for free, something that turned my trading around. Doesn't cost you anything. So I appreciate the thanks and the people that enjoy our presentations, because I always want to give you some bit of information, something that I've accumulated in my 36 years of trading that will hopefully be able to elevate your trading. And then if you like it well enough, then I invite you to become members of Specialist Trading. And lastly, yes, this presentation is recorded. This presentation is always recorded. Just contact Don or Brett or myself, and we will send you the link for that, okay? All right. It looks like we're come to the end of another presentation. I thank you so much for joining us. If you really want to get on the road to that consistency, the same way I got on the road ultimately after a long series of losing trades, I really invite you and really hope that you become a member of Specialist Trading. That is a great strategy number 4 that already comes at a very inexpensive price, and we're discounting it even more. So contact Don or Brett, and if you go to the website, protraderstrategies.com, you'll see it there for $6.95. But remember, just request the special link was sent to you that will give you the discount of $4.95, okay? Thank you so much for attending. Look forward to seeing you in the next educational presentation we give, and I wish you the best of luck. And as well, I hope to see you all become members of Specialist Trading. Bye-bye.